Hey everyone, Andrew Ellett here. Please forgive me in advance for my raspy, froggy voice. I'm recovering from a nasty cold, but I did not want to delay the email newsletter any longer. So hopefully you can hear what I'm saying. You can make out my words and it's not too annoying. But lately I've been getting a ton of questions about mortgage interest rates, especially with many of us expecting that they would have come down by now. But it looks like they might be staying higher than expected throughout 2025. So I'd like to dive into this a little bit and see what this means for you, whether you're a buyer or a seller or maybe both. Higher interest rates affect buyers because it gives them less buying power. But they also impact sellers who want to become buyers. And if you locked in a interest rate of around 3% before 2022, you might be hesitant to sell your property and jump into a new purchase, especially with rates, now hovering around 6% or even more. So many buyers have been waiting 1-2 years, even more, for a rate drop to re-enter the market. And at the start of 2024, experts predicted we would see 5 or 6 rate cuts, which sounded very promising. But the Federal Reserve only reduced rates 3 times throughout the year, and they were very, very modest reductions. This year, we're not expecting a big change in interest rates. After the last consumer price index report, Bank of America and others predicted that the Fed is likely to keep rates where they are for probably the rest of the year. And with inflation still high and the labor market strong, we might be looking at rates remaining the same into 2026 or even longer. So what do we do in the meantime? There are still some creative solutions for buyers and sellers who want to make a move. One option that I've talked about before is a 3-2-1 buy down. And so that lets you reduce your rate by 3% the first year, 2% the second year, and 1% the third year. And it helps buyers get in a home now while prices are flat and sellers are a little more flexible with negotiation. And it gives you the option to refinance when rates improve down the line. Another strategy, if you're a buyer, is consider negotiating with the seller to buy down your mortgage rate rather than just asking for a price reduction. A rate buy down can save you a lot more money over the span of a 30-year mortgage than just a $50,000 or $75,000 price reduction up front ever will. These strategies can help you buy a home now and potentially see market appreciation while waiting for the rates to come down a little bit. You'll avoid the buyer frenzy, which is likely to happen when the rates finally do come down a significant amount. For example, I recently sold multiple properties that I can think of in Teton County last year where buyers were hesitant to purchase because of the rates. And those properties have already appreciated approximately 15% over the last 12 months. This isn't the first time we've seen this kind of scenario. There's a lot of examples out there, but back in 1971, for instance, mortgage rates were around 7.3%. And if you said in 1971, I'm going to wait to purchase until the rates come down, then you would have waited 22 years until 1993 to see rates go down below that mark. Meanwhile, during that 22-year period, the real estate values nearly quadrupled in that time span. So don't let high rates keep you on the sidelines for too long. There still are ways to make this work for you, and whether you're a buyer or a seller or both, there are opportunities out there. If you have any questions or want to explore these strategies further, please feel free to reach out. I'm here to help you navigate this market. And thanks for watching. We'll see you next time.